Welcome to the Joseph Apartments Talk Show. I have a very exciting guest today, Phil Atwan of Asset Exchange Company. Phil, welcome to the show.
Jim, I am so happy to be here today.
Phil and I go way back. Phil, let's get right into it. You are an expert on the 1031 tax-deferred exchange. You speak to about 150 audiences a year?
For the last 28 years, yes.
So 150 times a year, realtors, escrow companies, enrolled agents ask you to come speak on this one topic.
Yes, sir.
You are the expert in Southern California.
Well, I hope so.
In the land of the blind, the one-eyed man is king. Tell me about a 1031 tax-deferred exchange. What is it, and why is it such a crucial part of our industry?
Well, that's a good question. In 1921, before you and I were even born, Jim, Congress got together and decided to create this thing called a exchange or a trade. They were trying to initially help out.
Did you say 1930?
No, 1921.
That's how old this is.
Yes, that's how old this is.
People think it's kind of a new thing.
It's not new at all.
That's FDR? Or Woodrow
1921?
Wilson?
Yeah, I don't know who the president was at that time.
Okay, so in 1920 they came up with this idea.
Yeah,
okay.
And they eventually put it into the tax code, which allows, at that time, farmers to trade properties with each other to not have to pay capital gains taxes. Well, it evolved to all kinds of investment real estate, so that today you can go ahead and sell any kind of investment property or business use property or even vacant land and exchange it into other investment property. That's what a like-kind exchange is, from one kind of investment to another kind of investment, whether it's personal or whether it's units or something you're renting out or using for your business.
Now, back in those days, did you have to have a more expensive property exchanged into, like two farms? Could they be comparable? Was it still?
It had to be still equal or greater in value. Usually it had to be an equal trade. If not, the other person then would pay the taxes on their difference because they sold for higher than what they traded for.
I didn't know it was that old.
Yeah.
Now, why should someone do a 1031 tax-deferred exchange? Or why? What's the main purpose?
Well, when you sell property, you pay taxes if there's a gain. It has nothing to do with the amount of equity you have. It's based on a capital gain. And a capital gain, very simply explained, is the sales price minus what they call the adjusted basis. What is that? It's what you acquired the property for, plus capital improvements, minus depreciation, and then they add in closing costs. When you put it all together, that difference, regardless of the equity, is your capital gain. You would pay taxes. Today, you would pay 15 to 20% to the IRS. If your gain is over $200,000, then you would pay an additional 3.8 for the new health care program, the Affordable Health Care Act. I don't think it's so affordable to the investors.
So 1520 federal.
Yeah.
What's state then?
State is, in addition to the health care, California will be between 9.3 to about 14.4%.
So 15 plus 3 plus 9 or 10?
Right.
What does that come to?
We'll call it 12. I mean, a lot. And then there's a depreciation recapture tax at a 25%. So when you put that all together, the federal government says we will allow you, if you will buy replacement of equal or greater value and reinvest all the cash into your acquisition, we'll let you literally not be tax-free, but tax-deferred.
Go back just a quick second. On average, in California then, on average, what is that total amount then?
9.3 to 12.3.
No, federal, state, and then the insurance tax. What's that total then?
That would be
15,
somewhere in the
plus
neighborhood of 25, 28%.
Okay, so if they don't do a 1031 tax-deferred exchange and they sell their property, you'd be hit with a 25% tax on your capital
plus
gains.
Plus depreciation.
Yeah, what does that come to typically? Well, someone owns a building for 20 years, let's say.
It usually averages between 30 and 45% of the capital gain. That's kind of an average. Some will be less.
So 30 to 40% of 25, right? So earlier we established 25 would be federal and state.
Right.
So you add the depreciation on top of that, what would that be then, roughly?
That's what you're looking at, depending on where you're at and what your income bracket is.
Just on average.
Somewhere between 28 to, let's call it, 40%.
Of the 25%, right?
Of the gain.
Of the gain, okay.
Yeah.
So what does that total come to then? If you had to ballpark, if someone owns a building for 20 years in Southern California and they're an average tax bracket, if they don't do a 1031 exchange, if you combine state taxes, federal taxes, the insurance tax, and then the depreciation.
But it depends on their gain. So for example, let's say their gain is $1 million.
Okay, let's say $1 million.
Okay, so what is 30 or 35% of $1 million? The answer is $300,000 to $400,000, depending on
a lot of
their
money.
Tax bracket. Absolutely,
That's why people listen to you.
That's right.
They don't want to pay that
Finally,
money.
somebody's telling a little bit of what's the reality of what's going on, and the government says you can keep that money and put it into the acquisition if you utilize this tax code called Code Section 1031.
So you're speaking to 150 audiences a year.
Yeah. Sometimes a little less.
What
by
is
10.
the main misconception that people have? So you're looking at your audience and you go, I just want them to know X. What is X?
There isn't a main. It's a culmination of a lot of different things. Folks think that I'll just buy another property and that'll be okay. Doesn't work. You have to have the exchange set up prior to the closing of the escrow. So whether it's an escrow company, a title company, or an attorney, whoever's doing the escrow, we literally have to put documents into that escrow. And that allows us to set up the documents for the exchange, hold the funds in between escrow.
It can't be an afterthought, in other words.
It cannot be an afterthought. Well, it can be, but it's not going to work and you're going to pay the taxes. That's just the bottom line. So the bottom line is that you have to hire a company like ours, a qualified intermediary, accommodators we're called. That's the street language. And we enter into escrow, set up the documents, hold the funds in between, put the money into the new purchase with a new set of documents as a replacement property, and you have thereby deferred all that tax that we just discussed into your new investment property or properties, because you're not limited to just one acquisition.
Okay, well, so let's just say I list an apartment. I list a 21-unit building in Buena Park on January 1st. Okay. I list it, I put it on the market. When do you think the seller, let's say a seller wants to do a 1031 exchange. When do you want the seller to contact you? You want to be contacted when it's listed, right? At what stage do you want me to say, hey, Phil, Mike Smith has their 21 unit listed. When do you want to get involved?
We always like speaking with the client earlier so we can give them the details of what to expect.
Upon listing?
Or even beforehand.
Okay.
But we really need to be involved after the escrow opens. We hope that it's a week before escrow.
You want to sink your teeth into my client's life right away, don't you?
You know what? We have to indoctrinate them, make sure they know the difference.
So are you going to send them material, literature, educate them on the process so it's not a surprise at the time?
And then we ask them to call us back if there's anything they don't understand or they need a little guidance.
Okay, so let's say I listed on January 1st.
Yeah.
A month later, we get an offer. 3 weeks later, we get an offer. What do they do then? What's their process? So they're signing the buyer's contract, they're signing escrow instructions, they're going down that road. When do you jump in? What do you want to know?
The realtor is going to put in language in the contract that says that the seller is doing an exchange, the buyer is going to cooperate at
okay,
no
you
cost
want me
to the
as
buyer.
a listing agent?
Yeah.
Well, actually, the buyer's agent puts that in an offer. It says the buyer is going to do a 1031 exchange at no cost or delay.
You could put that in there. You may want to have a delay if you're the seller, because you have X amount of time to go into your replacement property to identify in 45 days.
Okay, so you want me then, or the listing agent should put in there, subject to
a 1031
the
exchange.
seller finding locating 1031 exchange property.
You can do that as well.
Otherwise, we can't close escrow on this down leg, right?
That is correct. Okay. However,
you want to see that verbiage because otherwise...
But it depends on how you word it. And for example, there's something called a seller's intent to exchange zip form. It's part of the CAR form. It's a very good form for two reasons. Number one, it allows us into escrow to be able to facilitate this exchange because the seller and the buyer have to agree on everything.
So you want to see that in there then?
Yeah, but number two, it allows you to put contingency language in that contract, which says that you could extend escrow if you need to for X amount of days, X amount of times, whatever you want. Some people say, unless I'm in an escrow on a purchase, I'm not going to close the sale.
Okay, so
this helps you define what that means.
Your time frame begins when we close escrow, right?
Yes.
So you're saying that maybe, Jim, an idea would be for your listing to be, for the escrow to be extended because the buyer hasn't been able to find his up-leg property yet. So let's put in there some verbiage that allows the seller to extend the escrow.
Yes.
so that your clock doesn't start ticking. So once your clock starts ticking, we're in trouble.
Well, because that's the IRS's clock, and the IRS says you have 45 days from the time the sale actually closes, when the benefits and the burdens transfer from the seller to the buyer.
Okay.
When that happens, that's when the clock starts ticking.
Okay, so we got this property listed January 1st. We have an offer a third week in January. We then receive an offer, and then we counter saying subject to, and then possible extension.
Right.
Do you have a problem? Do buyers sometimes balk at that and say, we're not going to give you an extension? Make up your mind, find your property.
Some buyers want a 10-day escrow. Some buyers are very flexible. It just depends what you can negotiate as a seller's agent.
So ideally, we try to get some verbiage in there. Now we close escrow. So we February 15th, we close escrow.
Right.
Then the proceeds from my 21-unit building go to my client's hand, my client's checking account, right?
No.
That's a no-no.
We have to hold it.
Okay, so the money from ABC escrow on the 21 goes from escrow to asset exchange company.
Right.
I don't know you. I don't trust you. Why would I let my money from my equity that I built up over 25 years go to a company I don't know? I want it.
Well, that's why we give them acknowledgments of where the money's going.
So you've been educating my client in this time period.
Yes.
That you're a trustworthy, bonded, licensed company.
Absolutely.
You're like a bank, really, when you think about it.
Well, we work very closely with the banks because we are a fiduciary of those funds, and we have to make sure that they're safeguarded, there's plenty of insurance, and if there's a fraudulent type of thing, cyberspace enhancement to attack these accounts have gone up exponentially. We have to do all that we have to do with the bank to make sure that, number one, it's the client who's requesting that the funds move, and number two, they move when they need to move.
So I'm the owner of the 21 units right here. You're talking to me.
Right.
Tell me why I should be comfortable letting my money go from the escrow company to your company. Make me feel comfortable in 2 sentences or less.
Errors and omissions insurance. We've been doing this for 20 plus years now. The bottom line is our clients have never lost one penny. And we constantly are monitoring and upgrading software to make sure that will always stay the same. In addition to that, when it's time to move the funds and you've already approved it in writing, we're going to text you to the cell phone you give us when we're setting up your exchange and say, okay, we're moving the funds. Are you still good with this?
Okay, so the 21 units closes escrow. The money goes from ABC escrow to asset exchange company.
Right.
It's sitting there. Then what?
It doesn't sit with us. It sits at the bank.
Okay, then what happens?
And then they have the 45 days to name what they're going to buy.
So now I'm representing the seller. I'm going to represent them as a buyer.
Right.
We're then going looking at property.
Right.
We should have been looking a lot earlier, but hopefully we've identified a property by now.
Yes.
When do we have to tell you of the property we've identified?
No later than day 45 after the sale is closed.
Within the 45 days?
Yes, sir. You can change that identification.
Can I give you multiple properties to
Under
identify?
the 3-property rule, you can have as many as 3 properties on that list.
New?
That hasn't changed since the 80s.
Okay, so I can send you 3 properties and say, asset exchange company, my client is going to exchange in one of these 3 properties.
You can say it'll be only one, or you can say I'm undecided, which means you can possibly buy more than
breathing
one.
room. I didn't know that. That gives me some breathing room. I don't feel so tied down.
Oh, yeah, absolutely.
Okay. So now we make an offer on that property.
All right.
I'm going to make an offer on that property on behalf of my client, the seller of 21 units.
When are you going to make that offer?
I'm going to make within the 45 days.
You don't have to make that offer in the 45 days. You can make that offer before you close the sale. It doesn't matter when you open escrow to the IRS. What matters is when you close escrow. So they're looking at the closing
earlier
of the
than
sale.
the 45 days then.
Yeah, you can open the escrow anytime you want.
Okay.
It's just naming the address up to 3 within the 45 days.
Okay, so within the 45 days, I've identified 3 properties. We're going to end up with buying 12 units in Brea.
Got it.
Okay, so then we open escrow on that one. On that one, we say subject to the closing of the units, the 21 units in Buena Park. I tied that in, right?
You can do that if you want, sure.
Okay. Now, at what point in time are you talking to these escrow companies?
As soon as the client says we're ready to move, we ask that you give us a week at least before any escrow closes so we can set up the appropriate exchange for them.
So you want to be in touch with the escrow officer on my 21 units in Buena Park. You also want to be in touch with my escrow officer on my 12 units in Brea.
Sure,
You're kind of nosy. I mean, your fingers are in everything.
It's got a large nose. So the bottom line is that we also will put in at the client's request, as long as they've closed the sale and we're holding the funds at that point, an earnest money deposit to go into the acquisition of Brea.
Okay, so the deposit on the Brea property doesn't come from my client. You are going to provide the earnest money deposit from the accommodating funds.
As long as they've closed the sale. But if they have not closed the sale yet, and your client really wants to get into escrow on Brea, then they write their own earnest money deposit, and then the escrow company will reimburse them upon the closing of that acquisition.
Okay. So in this scenario we just described, what are the biggest mistakes you see people make? I mean, I just painted a pretty straightforward picture of 21 units in Buena Park, 12 units in Brea, 2 escrow companies. I've tried to tie them in with contingencies.
Right.
What mistakes do you see in this scenario that the realtor makes or the seller makes or the buyer makes in that you see that you have to clean up or correct, or you go, you guys did it wrong, sorry,
right.
You can't do it?
Number one, you closed escrow. You didn't invite us in. You didn't give us enough time to contact escrow, get what we need from the escrow company to set up the documents. We sent out a DocuSign. You have to sign that. All this has to happen before the closing.
So the number one thing is not enough time on your end to get stuff done.
Yeah. Or my cousin or my friend said I didn't need to do a 1031 exchange. You can do this thing called, you get $500,000 off of your capital gain. Well, that's your primary residence. That's called the 121 principal residence exclusion. Doesn't apply to your apartment building if you don't live in it.
So what are the biggest mistakes then?
That's number one.
Besides that.
Number two, fail to identify.
The upleg.
Yeah, the replacement property in the 45 days. That by itself is the worst mistake that could be.
So I ran out of time.
Yeah.
And it turns out there's nothing available that I want.
But that's why you should have negotiated up front that extension to escrow. So you can get into escrow, approve a preliminary title report on the new, approve a physical inspection on the new replacement property. Then you can release and then say, okay, now we can close.
Otherwise, you're under tremendous pressure on the upleg, and you end up making a bad decision because you have no time.
Unless you want to do a different kind of exchange. There are several different kinds of exchanges. One is called a reverse exchange. A reverse exchange allows you, as long as you have enough money, either going in all cash or cash and a loan, to allow you to close the purchase first through us and then close the sale up to 180 days later. So you can do it backwards, and the federal government allows you to do it. But another common mistake is you go ahead, close the purchase, take title to the property, and then you call me and say, well, I'm selling this one. I want to exchange into the one I already own that I just bought. The answer is, forget about it. You can't do it that way because the federal government says we have to be involved to make this tax-deferred event work, whether you're selling first or buying first. Yes, we can't. After the fact, the fly's in the ointment, it's over. So you can't unscramble the egg.
You're very proud of your children.
I am.
How many do you have, and what are they doing?
Thank you for asking. My oldest is they've got 5 kids now. She and her attorney husband. He's a real estate attorney. He's on the board of directors at the Orange County Association of Realtors. He does a lot of real estate law. And she's a great, not only a homemaker, but she's homeschooling and now in a hybrid because the kids are getting larger. The middle one, he's in the mergers and acquisition business down in West LA. He goes a lot between here and San Francisco. He works with attorneys all over the country for the purpose of merging and acquisition. So he won't touch anything under $50 million. He's got a couple of $2 billion mergers and acquisitions. He's doing well. We're still looking for a wife for him, but I'm sure he can take care of that. Number 3, the youngest one is also married to an attorney. She works for the corporate office today of In-N-Out, and he's a lawyer, and he deals with all kinds of ugly things. But the bottom line is they've got a beautiful little son. We have 6 grandkids, my wife and I, and we love each other. We love life. God's been good to us, and we want to be good to other people.
A lot of attorneys in your family, huh?
You think I could have gotten at least a doctor out of this thing, especially getting older.
It's God's
now,
way of saying straighten up, Phil. Yeah. Now, can a California owner exchange into another state, and what are the tax issues involved? And and piggyback on that question, what states are you seeing money going to the most? What's going on?
We're seeing a lot of the Southwest belt, where we see North Carolina, South Carolina, Florida.
Southeast belt.
Yeah. Did I say Southwest?
Southeast.
No. Yeah, Southeast. Sorry.
North Carolina.
South Carolina, Florida, Texas, Tennessee's really big. Arizona, we see it in Nevada. We're seeing some, believe it or not, in Ohio. That's actually heating up. We're getting some in some other states, some a little northwest, but not so much. They're looking for states primarily that are either no tax states, but more importantly, have balanced laws for both owner and tenant. The problem is California has gotten so far unbalanced that all the legislation is there to protect the tenant and not the owner. And like Mr. Miyagi says in The Karate Kid, you must have balance, and we do not have balance in California. And that's why we're seeing it literally between 3 to 3.5. Every exchange is leaving California that we're doing. It's amazing.
Say it again.
30% to 35% of every deal we facilitate for 1031 exchanges in California are leaving California.
What's the number one state then? Texas?
Yeah,
Florida?
it used to be. I don't know which is number one. I just know that region that I sort of painted for you, that's where they're going.
Do you find when people sell a property in California, they buy the same kind of property out of state or within state, or do they typically change property? If I'm going to do a 1031 of an office building, do you typically end up buying another office building, or do you see a difference?
It depends. You know, Jim, investors are going into different types of properties now that they didn't go into before. For example, if I'm in my 70s and I have an apartment building, I may not want to be a landlord anymore, but I don't want to pay the taxes. But I love the equity and the income that comes to me each month. So what I do is I go into one of various types of acquisitions. One could be a triple net property. So you were talking about getting your coffee from McDonald's today. Well, you can buy a property where McDonald's is your tenant, or Starbucks is your tenant, or Chick-fil-A is your tenant, or CVS is your tenant, or Bank of America, or State Farm, or whatever, Amazon, where you buy a warehouse, and that's your tenant. It's usually triple net lease. So basically, you don't deal with the day-to-day maintenance. You don't deal with the insurance of the property taxes of the property. The tenant takes care of.
So you're seeing a lot of that then?
That's a big deal today.
So
but you have to have a lot of money to come out to go into a triple net. But it usually has to be $2 to $3 million just to begin and higher. There's a second kind of property that investors are going to. It's called a DST. D stands for Delaware, like the state. S for statutory, as in law, and T is for trust. So it's a trust that they create in the state of Delaware, where they have all these properties all over the place where you could actually, if you don't have 20, 30, 40, 50, 80 million dollars, you can buy a fractionalized interest of that property where you're out of the management business. You get your monthly income based on your rents that are generated from your percentage, minus cost. And that's a good win for a lot %
Go to the last 100 deals that Asset Exchange Company has done. Okay, give me two questions. What percent of them are in different avenues? In other words, what percent do they buy another apartment building versus a Delaware Side Trust or charitable? What do they? If you could break down the last 100 deals you've done or 10 deals you've done, where do people put that? So an apartment building owner, not a commercial, but an apartment building owner, the last 100 deals you guys have done, where, if you broke down where they put their money, what would you say? I mean, what percentage is Delaware Statutory Trust, for example?
I'd say a DST will probably be around 35 to 45%.
That's huge.
It is huge. It's a booming area right now.
So it's 30 to 40% of apartment owners in Southern California that do a 1031 tax-deferred exchange put in a Delaware Statutory Trust.
50% of them are going to go back into apartment buildings.
That takes us to what, 80%, 85%, 90%?
Yeah. The rest is various type of shopping centers.
Wow. So it's either another apartment building or a DST, period. End of story.
Well, the majority, not exclusively, obviously. Big deal.
Interesting.
It's a big deal.
What percent of 1031s are audited? In other words, if I do a 1031 exchange and I mess up or something, do you have any idea what the odds of being audited and busted for doing it the wrong way is? Are there any stats on that?
All we can do, no, there are no stats, but all we can do is kind of judge by what we see. And, we're pretty large. So I would say at this point, less than 5%.
So your odds of getting
Right.
nailed are low.
Right.
What red flags trigger IRS scrutiny? In other words, is there anything that you can see
Right.
that's done wrong where the IRS would say, okay, let's take a look at this one?
Yeah, you haven't been claiming a building in terms of income, no depreciation, and all of a sudden you're taking a second home or vacation home or an apartment building that you haven't been declaring rents on, and you want to do a 1031 exchange. So you're basically committing tax fraud by not reporting the income, and then you want the tax-deferred benefit to go into another investment property. That's not a good idea. So, but people are trying to do that. It's amazing. People are looking for more and more reasons to kind of skirt the law and find another way of not paying taxes when they sell these high-ticket items like apartment buildings.
What does a 1031 exchange accommodator charge then? So I've got $1 million property, and I'm going to do a 1031 exchange. What is a typical fee for handling that? Usually
between $1,000 and $1,500 on a straightforward delayed exchange. That's
all for saving 40% of my money.
It's amazing. It's amazing.
Are you willing to accept more?
Yes, but I try to have pity on my flock.
So for $1,000 to $1,500 to Asset Exchange Company, you can handle
we charge $1,250.
$1,250. You can handle all this paperwork and then save me 30 to 40% in taxes.
And that comes with 3 replacement properties in one sale.
Ran by a reverse exchange.
Right.
You and I did a reverse exchange on a property in Montebello a couple of years back.
Right.
So tell me the benefit of that. So a reverse exchange, instead of the 21-unit property, what I described, I would then go ahead and buy the 12-unit apartment building in Brea I talked about earlier. So I then purchase that property. I tell you about it. Hey, Phil, my client is purchasing 12 units. We're in escrow, ABC escrow. And then I've got your blessing. Then I turn around and then I sell my 21-unit building in Buena Park. So walk me through that then. We're doing the whole thing an opposite.
Okay. So you're going to acquire this
12 units in Brea.
In Brea. So what happens is we want to make sure you have the financing, you have the cash to do it. We have to begin and hold the new property that you're going to acquire.
Okay, so it's acquired in your name.
Yes.
Okay, so
in an LLC that we began. Actually.
Okay, so as far as the IRS is concerned, my client isn't buying the property. An LLC that you run is going to take ownership of the 12 units in Brea.
Correct.
So Asset Exchange Companies LLC owns that property as far as the IRS is concerned, even though my client really owns it.
Your client is going to be the manager of that LLC as well, and we're going to work out a triple net lease agreement with them to go ahead and utilize the property as soon as it closes. The clock begins to tick as we take title to that property.
Okay.
On closing Buena Park.
What's the clock?
180 days, just like a delayed exchange.
But I got more time. I feel like I've got more time.
The key is to buy the right property.
I feel like I'm in the driver's seat then, because it's easier to find a property than it is to sell a property.
It is.
In today's market. Okay, so...
But the right property is what counts.
Okay, no, my 12 units is the right property. I like the property. Right. I'm closing escrow on the 12 units.
Okay.
We've then closed escrow. The ownership is an LLC that's in Asset Exchange's name. Now then, I then put the 12 units on the market.
Well, technically it's not in our name, but we give it a name, yeah.
The 21 units is on the market then.
Right.
We then go into escrow.
Good.
I notify you.
Right. We set up the documents for that.
And then the ownership is over there. Documents are there.
Right.
And then we close escrow on the down leg.
Right.
On the down leg.
The relinquished property.
And the money comes from this new LLC. So we have to escrow for that then, right?
Well, you had the escrow for the purchase.
Right.
And now, you floated money, and now we're going to close Buena Park, the sale.
Okay.
So what's going to happen then is we'll receive the funds, and the client who had anything they floated out of their pocket, they get reimbursed on up to that amount.
And the fees, all the fees involved?
That's different.
Okay.
Fees for that is usually between $8,000 and $10,000.
Okay, so So a standard 1031 is $1,250. A reverse exchange is $7,000, $8,000.
8 to 10.
Why do people prefer the clients that do a reverse? Why do they prefer that to a standard then?
The key to any exchange is not selling; it's buying the right property in the right location. And many are willing to wait until they find opportunity
in a seller's market.
On their
in
door.
A seller's market, where the sellers
market.
have all the cards,
right.
A reverse exchange makes more sense.
We're not in a seller's market per se now.
No, but let's say you're in a hot seller's
we're
market.
We're in a very low inventory market.
Right.
Which means even though you want to buy, you haven't found the right property. If you sell and you can't meet the 45-day identification and close within 180 days, you're going to pay a lot of money in taxes.
180 days is a much better span than 45. I mean, the runways, so that's an advantage there.
Right.
And if you look at that in a tight market where there is no inventory, 180 days, $7,000, $8,000 is a small price to pay for the freedom of having 180 versus 45 days. What percent of the last 100 deals that you did are reverse versus standard then?
Probably 10%.
So it's pretty
12%
it's pretty
reverse.
Rare. It's pretty rare then.
Yeah, it is. Well, I won't say rare. It's just not as often. Rare means one every 100. I'd say out of every 10, one of them to two of them are going to be reverse.
This is like open mic night at the Improv.
Yeah.
What would you tell my clients then if you had a direct link with my clients? What would you just look in the camera and tell them do this, do that?
Do a delayed exchange if you can. It'll cost you less money. The goal is to get both properties in escrow at the same time, to close the relinquished property because you have a good buyer. The buyer's qualified, the cash is there. And the property that you've done the inspection, you've done your due diligence on this property, it's exactly what you wanted or as close as you can get to what you wanted. And then you can close that within the 180 days with the 45-day identification. That's the ideal situation. Second, reverse is great. It's just going to cost you more, and there's a lot of moving parts. You're working with the legal department. But the bottom line is, and that's why you're going to pay more, and there's a lot more paperwork. But if you think about it, if you're willing to wait and find that right property, and you're ready, you're prepared to move with your cash and or your cash and financing, then the reverse exchange is a really good choice. But I would rather do it delayed because it costs me less.
This sounds like a very complicated procedure.
It is.
You deal with hundreds of realtors a year. Would you say that maybe someone like...
Probably more like thousands, but go ahead.
Don't you think that given the complexity that someone like James Joseph with 45 years experience doing this is the person that would be best handle something like this?
Well, you would be best speaking with us, and we would humbly make recommendations to you and to your clients. We would love to speak with them so we can deal with their concerns.
You didn't answer the
and
question.
questions. I thought I was running for president or Congress.
What type of real estate qualifies for a 1031 exchange?
Any investment property. It's not the property you live in. It's not your second home or your vacation home. It's something that you rent out for at least 14 days a year.
14 days a year?
Yeah. So you can have...
I could 1031 my Airbnb.
Absolutely. But you can't use it more than 10% of the time that is rented with a minimum of 14 days.
Okay. So I've got a house in Big Bear. I own it. I want to do a 1031, but I'm renting it out to a Airbnb. But I can't occupy it more than how many?
14 days a year or 10% of the time that it's rented.
I can't live in
whichever's
there.
greater.
I can't live in there in my Big Bear more than 10% a year.
14 days, we'll call it.
So that eliminates a lot of second homes then, third homes then.
Second homes are pretty much not allowed.
Okay, let me reverse the question then.
But you can convert it.
I own a house in Big Bear. I own a house in Big Bear. I want to do a 1031 exchange.
Right.
I live there 3 months out of the year.
Right.
Okay, now what do I do differently now so that I can exchange? So in 2025, I've lived there 3 months out of the year.
Yeah.
Now you're advising me on 2026 on what to do because I want to do 1031. What do you tell me?
Don't live in it for 300 days a year or 30 days a year. You really need to make sure that you're not exceeding that 10% of the time that it's rented, but they will give you a minimum of 14 days.
Do you want to see a lease? What do you want to see?
I don't want to see anything.
You take my word for it?
That's between you and your CPA should you get audited.
Okay. My CPA then should have some sort of a record. How do you disprove a negative? How do you say I didn't live there?
You know all those drones that have been flying around these days? Not that say IRS on there, or worse yet, the state of California. No, I can't prove it, but I'm not here to prove that. I'm here to take what you are telling me is true, and that you've spoken with your tax counsel about it.
To play it safe,
Yeah.
I should give or have some sort of a written documentation that I'm not living there, but that someone else is there, or it could just be vacant.
And
right?
that's called your tax return.
Can it just be vacant?
Not if it's a structure. Vacant land, yes. Structure,
But a
no.
vacant house, they assume that I'm living in it then. So I have to.
Or it's a second home.
Yeah, but in order to do a 1031 exchange, I have to prove that somehow it's being rented out then.
If the IRS calls you out or the state of California calls you out, yes.
Now, like for like, that means what? I can exchange land for land?
Well,
Or is it just income
that's
property for income
impartial.
property?
Yes, both. What happens is if you're selling a 12-unit apartment building and you want to buy vacant industrial land in the middle of the desert, you may do that because both are considered either income or investment properties.
My land in the desert has to be worth more than my apartment building.
Equal or greater.
The up leg has to be equal or greater.
Unless you want to buy multiple up legs to total equal or greater, which you will identify in the 45 days.
Now, I heard that I can sell my 21-unit apartment building in Buena Park and buy an oil well in Texas?
If that's considered as real property, and the answer is yes, Texas, it would be.
How do you
considered.
determine the value of the... So my apartment building is worth $6 million in Buena Park. How do I buy something worth more than $6 million? Because land is just land, but then the oil comes out of it. So am I buying the land, or am I buying the land and the oil if I do a 1031 exchange to
oil rights are considered real property in Texas.
Right.
Water rights are considered real property in California.
How do I get more than $6 million in value then? It just have to
You're going to need a good appraiser.
Okay, so the appraiser then would determine that the land and the oil well equals X.
The proposed oil, yeah.
No, it's gushing right now.
Yeah. Oh, it's gushing. Yeah, then you can. And you can buy an oil well land with oil coming out of it as rural property. And the government would consider that a good, like-kind 1031 exchange from an apartment building to that oil well.
So asset exchange company would take my 21-unit building in Buena Park and say that anything that is generating income is like for like? Is that the definition?
Any property.
Any property.
Because you can have a business and a property, but the business is not allowed to be exchanged anymore.
Okay, so
only the property.
So I can't do a 1031 exchange
on your dental
from
practice.
Buena Park and upleg a leased property, a leased Wendy's in Delaware. I can't do that because I don't own the upleg.
The property, yes. The business and the equipment and the inventory, no.
How do people get a hold of you?
Area code 323-570-1031 or teamphil@ax1031.com.
Phone number?
323-570-1031.
Website address?
AX1031.
Mother's maiden name?
I can't do that for privacy purposes.
Blood type. Blood type. What does the depreciation recapture affect? How does it affect long-term apartment owners? What is the whole thing with depreciation and recapture? You hear that a lot.
Yeah.
You go, you got to do this, you got to figure this, and then you have to turn around and figure out depreciation and recapture.
Right.
How does that impact this 1031 process?
Well, that's a good question.
This is so complicated,
I'd like to
Phil.
talk
I want
about-
to pay my 40%. This is so complicated.
I'm telling you. The government says that if it's being used for business or if it's being rented out, that you are to depreciate the property. It's called allowable depreciation. It doesn't mean you have to, but you're allowed to do it. What's the purpose of depreciation? It's to write off the income that is coming in. So, and the depreciation is going to be based initially on what the CPA comes up with. So if you bought a property for $1 million, the CPA is going to look at the $1 million and say that X amount is for the land of that, X amount is for the building. Only the building can be depreciated. If it's a residential building, it can be depreciated for 27.5 years.
That's a key number, right? 27.5.
Yeah,
that's
for residential.
That's the number.
Right. And by the way, 150,000 unit apartment building is still considered residential to the IRS. If it's
Hold on 1 second. How are we on time, Richard?
39.3.
39. Okay.
Oh, you can't see that?
It's 27. It's 27 for residential. What about for residential income?
Residential income is 27.7.
Same. It's the same.
Yeah, 29.7. 27.9.
It's the same.
Yeah.
Okay.
27.5. Yeah. So it's the same. So if you buy a 1,000-unit apartment building, it's still 27 and a half years.
So even though the value is going up dramatically, the IRS is saying it's declining in value. It's depreciating. The wood's getting old.
The wood's getting old. The sun's beating up the
Makes no
roof.
sense whatsoever.
Yeah. But you're allowed to take that, and what it does is reduce rents. I'm sorry, it doesn't reduce the rents. It reduces the taxes you pay off the rent you collect.
Now, do you find that people will then do a sale when they realize from their CPA, you've lost, it's been 27.5 years.
Well, you probably will do it before that.
But
Why? Rents are going up.
Right. But
Depreciation is flat.
That's a trigger for an apartment owner to sell because a very valuable tax benefit is disappearing, correct?
Well, it is, but it isn't going away. You're just making more money off your rents because your rents are going up.
Right.
So the depreciation doesn't just go up with the increased rents. So what do investors do based on CPA recommendations? Sell the property for $3 million and buy one for $5 million. And the part that you acquire up that is a value of the building starts another layer of depreciation for you. It's less expensive to go to another building to pay a lender than it is to give it to the government. And that's why investors re-leverage the equity into bigger, better buildings or multiple buildings. Maybe they don't want to have them all as apartment buildings anymore. Maybe they want a couple of commercial buildings or mixed-use buildings. So the bottom line is they can take that money, take it anywhere in California or anywhere in the United States and acquire other types of properties that are going to make them more money. Income, appreciation, tax write-offs. Those are the three driving forces why any of us.
Say those three again.
Income, appreciation, and tax write-offs. Depreciation are the biggest driving forces that influence you and me to go out and buy and own investment property.
What question have I asked you that you want me to ask you?
Well, why people are exchanging now. It isn't just to defer the tax, though that is huge. There's lots of other reasons. Buying up to get more depreciation is a big deal.
I ran out of my depreciation.
Or you're running lower. You're 15 years, 20 years into it, and your rents have been going up.
I want to restart it.
You don't restart it. You take it with you. That's why you're not paying the 25% tax. But when you buy up,
I want to take it with me, but I can start at the top, right?
But when you buy up, whatever part that you buy up, that is improvement value, you're starting from the beginning on that. So you're running multiple depreciation tables. The second reason is people in California especially are getting very frustrated with HOAs. Give you an example. We bought this.
There's no HOA in apartments.
Well, there is not in apartment buildings, but there is when it comes to condominiums. Did I say apartment? Condominiums. Well, you don't.
Read the room.
Well,
Read the room. Read the room. Nobody cares about HOAs.
I don't see anybody in here. No.
Next reason.
Well, no. Deferred maintenance, fire and flood insurance.
Oh, insurance is huge.
They're moving those properties away from those areas and going into others. The reverse exchange is a motivation. I want out, but I got to know that I can buy first if I find the right property. The next one is low management responsibility. I don't want to be a landlord anymore. I'm tired of managing managers who are mismanaging my properties. So what am I going to do? I'm going to go look for a triple net, a DST. There's even something called a 721 UPREIT. Are you familiar with that? Mm-hmm, mm-hmm. And that's when your DST, after 2 years, if you choose to go into that, converts into REIT shares. So you have $1 billion REIT who's going to buy that building. So you're going to exchange your ownership deed for shares of that REIT.
Okay, so I can do a 1031 exchange from my 21 units in Buena Park. I can exchange into a Delaware statutory trust
with the 721 UPREIT,
which gives me a 5% return on my equity.
Okay.
by buying into a share of a 20-unit apartment building in Mississippi.
Right.
Okay. Then from there, I can do a
721 up rate.
720 up rate.
But you don't really do it. It happens automatically with the management of the company. What they do is after 2 to 3 years, they then will sell that property so you would turn your ownership to the new REIT in exchange for shares of stock or REIT shares. And that means that over time, you can still liquidate some of those shares if you want to gift some money to your kids, your grandkids. You can want to buy a boat. You can do that. You just pay taxes on the share of REITs that you sell. But it takes you to the end of your time. You can't do another exchange because you can't exchange out of REIT or out of stock.
Okay.
But that's your last exchange for that particular building that you'll ever do.
We went through a whole scenario of me selling my 21-unit building and then buying a 12-unit building in Buena Park, the whole scenario. Now, off the record or on the record,
this is being taped.
This is how it should be done. This is how it should be done.
Right.
Are there any afterwards shortcuts or scotch tapes or fixes that you can do? If I don't do this perfectly, is there anything where you can wiggle around or correct a mistake that my client made or I made? And if so, what can you share?
No, in terms of mistakes, yes, and other things. For example, but I wanted to keep some money. I wanted to do some repairs or improvements to the new building. So you either do a construction exchange where you get to do that, or just buy the property and then talk to your CPA. If they'll let you get a second on the building to rehab it or do whatever you need to do to it,
okay,
you can do that.
Okay, so $6 million is the 21 units.
All right.
And then I'm going to buy $6.5 million in Brea for 12 units.
Okay.
But I want to take some money out.
Yeah, afterwards.
Afterwards, yeah. So it closes escrow.
Right.
I can't take it out during escrow because I have to pay taxes on that. Yes. But I need $200,000 cash.
Yeah. For the purpose of rehabbing the building?
Or I want it what if I want it for myself?
If you want it for yourself, you probably want to season the hold for at least 6 months, if not a little longer.
Season the hold is purchase is a 12
purchase.
Okay. So I purchase it 6 months after I buy it. Yeah. I want $200,000 to give my kids.
So you refinance or you just take it out of the building. You're not selling anything. There's no tax on that. So you either do a pre-exchange refi a year before you list and sell it, or a post-exchange refi at least 6 months after you acquire it. Then you can get cash out of it.
What's the construction thing you were talking about earlier?
It's a construction exchange where you want to use the $3 million coming out of Buena Park to acquire the property and to do the improvements on the property. So what happens is that we start an LLC, hold title to the new purchase. With the remaining cash that we're holding, we'll pay the contractors to do the capital improvements. You identify the property and the improvements that you're going to do. At the end of the 180 days, we give you your property with all its improvements.
So even though I'm spending my own money, I'm not spending my own money because it's going through this. I'm not touching the money,
right?
But I am spending money
through us,
through you. So that's the
government permits.
That's the way to spend money on my property without touching it and paying capital gains taxes on that.
Right. That's a big deal. We don't do too many of those, but it's a big deal to those who do it. Another reason why somebody wants to do a 1031 exchange on their apartment building? Decline of value or rate of return. The problem is the rents have been going up, the equity has been going up, so why should I sell the building? The answer is, well, what's your rate of return on the equity that you have? So in other words, when you look at your equity, then you put into that the income minus the expenses of the building, the rate of return is not going up.
Mm-hmm, mm-hmm.
It's staggered or it's going down. Why? Because rent rates cannot keep up with equity value in Southern California. If you've had that property for 20 years, you're going to be really disappointed to find out what your rate of return is. In fact, if they want, they can send me an email. I will send them a copy so they can factor that out and figure out what am I getting back for all that equity I have in my building when you consider income and expenses. It's not going up.
Look in the camera again and tell my clients your email address and what you asked them to do.
teamphil@ax1031.com.
And what do they request?
Basically, just say, what's my return of equity worksheet? and I'll give them a little worksheet that I sat down with a couple of CPAs, and they said, this is how we determine how valuable the building is, or what your interest rate is on all that equity when you consider your income minus your expenses. What's in it for you?
I can't tell you how many times, guys and gals, I've been in a conference room with my clients and they have a question regarding 1031 tax-deferred exchanges. I have Phil's private bat phone number, and I'll call him, I'll put him on speaker, and he'll be right there talking to my clients, answering these complicated questions. And here's the deal. The law changes. So as soon as you figure out the law, it changes. I don't keep up with this stuff. I just rely on Phil to take care of this problem for me. So, if you have a question on this process, even before you even think about selling, give Phil a call now and have him walk you through the process. More importantly, have him send you the documents or get on his website. What's the website again?
ax1031.com.
And there's a lot of Q&As there to help with
Absolutely. Or just call me directly, and we'll send you some, after speaking with you and asking you a couple questions, we'll send the appropriate information so you don't have to dig through the whole website to find what you're looking for.
For me, these answers are not any good if I can't get them on the spot with my clients. And that's what I appreciate about Phil. Phil came all the way down here from his mansion in Mississippi to to provide us with answers. But don't hesitate to call Phil. He enjoys talking to you and giving you information. So, Phil, once again, your contact information?
It's my name is Phil Atwan, A-T-W-A-N. My email address is teamphil@ax1031.com. And, of course, my phone number is area code 323-570-1031. You'll speak with either Adam, my teammate, or myself. We're both very seasoned. We will make sure that we will answer all your questions so you can decide what's best for you.
I try to bring the best vendors in the business for you. And there's no one that knows this line of the apartment business better than Phil. I strongly recommend him. He's answered all my questions over the years, and I appreciate him coming in. Thank you, Phil, for coming in.
I'm honored, and it was a pleasure.
Thank you for watching. We'll see you next month on Joseph Apartments Talk Show.